Hi, it's Russell with VectorVest, here to show you a few easy but effective ways you can manage risk in your portfolio. Fear of losing money is the number one concern of most investors, and for good reason. But despite their worry, most investors are oblivious to just how much risk they're taking, right up to the point of no return. The fix, though, is knowledge. Knowing which risk strategies to use and when to use them will help keep you safe and sound. So here are 7 tips that VectorVest encourages subscribers to use to manage risk. You know you're going to have some losers no matter what. So the idea being here is that you don't want to put all your eggs into one basket, no matter how much you like the stock or the industry. Make sure you diversify in when and what to buy. Spread your capital among several stocks. VectorVest generally recommends between 5 and 20, and make sure they're in a variety of industries. We suggest no more than 2 per industry if you have a basket of 10 stocks. Now remember the dot-com bubble and the flash crash and the financial crisis. That taught us that relying on 1 or 2 industries or a couple of industries can come at a high price. Diversification can't do its job at controlling risk unless you dollar weight your positions. This means investing equal amounts into each stock. Use your head here though. If you take on a particular high-risk stock, maybe in the mining or pharmaceutical field, you may want to scale that back so you have much less exposure than your average positions if your investments don't pan out. Investors have their choice of some pretty great discount brokers these days. Make sure you've shopped around and chosen the one that fits your trading frequency. Also, don't overtrade. If you find you're selling loser after loser, then your stop losses may be too tight. And one of the most common reasons this happens is that you're not buying stocks at the right time. A little technical analysis will help you with that, but so will this. It's a lot easier to go with the crowd than against it. In fact, I wouldn't want to be the poor person that stands in the way of the stampede, and that's exactly what market timing is all about. A stampede of stocks. That stampede is either going to help push your stocks in the direction you want them to go or grind them into the dirt. So how do you know when the stampede starts and what direction it's heading in? Well, you can start by using a longer term moving average on a large index like the All Ords. As long as the price is above the moving average, I've got a 40-day moving average in this example here, it's okay to buy. We note that the market is bullish. If the price drops below the 40-day moving average, we note that the market is bearish. Now, if you can take advantage of VectorVest, you can use one of our powerful market timing systems. Here's one of my most favored timing systems. This system not only uses more sophisticated rules to track direction, but it also tracks momentum. When both are strong, you get the buy signal, but if they're weak or falling, you get the sell signal to stop buying and take protective measures. As you can see, it manages to hit the turning points with incredible accuracy, and these are real signals and not given in hindsight. So let me ask you this. Do you usually just jump straight into a swimming pool if you were to go down to the water tomorrow? A lot of us may like to simply dip our toe in the water to begin with, and that's what it's all about, stepping in. Instead of risking the majority of your capital all at once, consider picking up stocks 1 or 2 at a time and building your portfolio as your positions increase in value. That way, if you started a little too soon or a little too late, your portfolio won't take a major hit. Would you rather have a full glass or be stuck with an empty one? Let me add that we're actually talking about profits, not wine. If that's the case, we'd all take a full glass, but it's impossible to know when a stock has reached its peak. We can use stop losses to lock in as much profit as possible, but even then, we sometimes let our profits slip too far, sometimes disappearing completely, and that should never happen. Never lose more than 50% of a reasonable profit. Let's take a closer look at this. This is one of VectorVest's model portfolios in Australia, stalwarts, fully franked. To the right, you can see the gains or losses for each current position. All bar one of these stocks had big double-digit gains, so regardless of the stop losses I might have in mind, I'm not going to let myself lose more than half the profit, and I'm certainly not going to allow these winners to turn into losers. For Flight Centre, at the absolute latest, I would close my position if my return on investment went down to about negative 15%. For G8 Education and Slater & Gordon, if I hadn't taken profit sooner, I would quit making excuses and sell if my return shrunk to 50%. And I would just keep updating that information as my gains in each stock grew. Finally, we have the rule of rules. You should never risk more than 1 to 2% of your portfolio value on any single position. If you follow this rule, then a losing trade may trim back your profits, but if you don't, you could lose a lot more than you bargained for. Before you think 1% is ridiculous and impossible though, let me clarify that this is not a stop loss. With this rule, you can take any stop loss you want, even 75% loss if you wish. But even if you do that, the impact on your portfolio will be mild if following this rule. Here's how it works. Take all the money you're using to invest in stocks and multiply it by 1%. That's how much you can lose in any single trade. For example, if I have a $100,000 portfolio, then I can lose up to $1,000 in any single trade. If I have $30,000 invested in Flight Centre, I could afford a 3% loss before I should close the position. If I only invested $20,000, I could take a 5% loss. If I invested $10,000, I could take a 10% loss, and if I invested $5,000, I could take a 20% loss before jeopardizing my portfolio. So let's recap our 7 steps here. Number 1, diversify. Don't put all your eggs into one basket. Number 2, dollar weight. Spread the capital that we have around. Number 3, keep your commissions low. Number 4, use market follow-through. Make sure the market is going in the same direction that you want your stocks to go in. Number 5, step in. Think of only buying 1 or 2 positions on any given day. Step number 6, use the 50% rule. Don't give up more than 50% of your profit. And rule number 7, we've just covered the 1% rule. Don't jeopardize your capital. There's no better tool to help you do what VectorVest does. You'll not only get continuous coaching and daily guidance, but you'll be able to analyze, rank and graph more than 1,750 Australian stocks and over 8,000 US stocks for value, safety and timing every single day. You'll even get clear buy, sell and hold ratings for every stock every day. And you'll get a straightforward market timing signal so you can make sure your portfolio stays on the right side of the market. And it all comes with a money-back guarantee. It's so powerful, we promise you'll see better profits in 4 weeks, or it's free. Get started today and you'll have everything you need to make faster, smarter investing decisions.